know you're going to learn a lot watching this video.
This is Chapter 20 of Accounting 202, Master Budgets and Performance Planning. I will be reviewing the highlighted learning objectives. First, we'll look at the benefits of budgeting. The master budget process begins with the sales budget and ends with the cash budget and the budgeted financial statements. The master budget includes individual budgets for sales, production, various expenses, capital expenditures, and cash. A manufacturer's master budget should include several operating budgets, a capital expenditures budget, and a cash budget. And some budgets require the input of other budgets. We will look at preparing the operating budget for a manufacturing company. The first step in preparing the master budget is the sales budget. And the sales budget shows the planned sales in units and dollars. The sales budget is a starting point in the budgeting process because plans for most departments are linked to sales. The sales budget comes from a careful analysis of forecasted economic and market conditions, business capacity, and advertising. To develop the sales budget, companies must estimate both unit sales and the selling price per unit. We are going to prepare a detailed budget for Toronto Sticks Company, which is a manufacturer of youth hockey sticks. We begin with the sales budget. So we're going to call Toronto Sticks Company TSC. TSC sold 700 hockey sticks at $60 per unit. They prepare its sales budget for the next 3 months. In September, TSC sold 700 hockey sticks at $60 per unit. So using this price information and the forecasted unit sales for the colder months of the fall season, the sales budget for the remaining 3 months of the year are shown. A production budget shows the number of units to be produced. The production budget is based on the budgeted unit sales from the sales budget, along with inventory considerations. We start with budgeted ending inventory, then we add budgeted sales for the period which came from the sales budget. This will tell us the number of required units needed for the period, and then we subtract the number of units in beginning inventory because we already have those, and that gives us the total units to be produced for the period. A production budget is expressed in units of product. This is the production budget for TSC. We're going to use 3 steps to complete the production budget. 1, we will compute the budgeted ending inventory based on the company's inventory policy. We will add the budgeted sales, and then we will subtract beginning inventory, and that will give us the required units to be produced. So you can see here that for ending inventory, they want to have 90% of the next month's sales. So October, the next month would be November. So if you go back and look at the November, they're expecting to sell 800 units. 800, which is November expected sales, times 90% means they want an ending inventory of 720 units. Then we add the current month's projected sales of 1,000 to get the total required and subtract our beginning inventory. And that tells us how many units we need to produce. The direct materials budget will show the budgeted cost for the direct materials that we need to purchase. So we're going to use the previous budget, the production budget, to help us prepare the direct materials budget. So to prepare the direct materials budget, we need to know the number of units that will be produced, the materials requirement per unit, the budgeted ending inventory in units, the beginning inventory in units, and then the cost per unit. So for Toronto Sticks Company, we're going to begin with the budgeted production from the production budget. Then we need to know the amount of direct materials needed for each of these units. So in this example, we need 1/2 pound of wood to make each unit. So now we can compute the amount of direct materials we need for production. So to produce 710 hockey sticks, we need 355 pounds of wood, which is 710 units times 0.5 pounds for 1/2 pound. So we also want to have something called a safety stock just to make sure we don't run out. So we want to have safety stock of direct materials on hand at the end of each month to complete 50% of the budgeted units to be produced in the next month. Since they expect to produce 1,340 units in November, that would require 670 pounds of material. It needs ending inventory of direct materials of 335 pounds, which is 50% of 670 units. We want that in inventory at the end as our safety stock. So their total direct materials requirement for October will be a total of 690 pounds, which is the 355 plus the 335. They already have 178 pounds of material on hand in their beginning inventory, so we can subtract that because we don't need to purchase what we already have. So for October, the calculation is 690 pounds minus 178 pounds that we have, and that equals 512 pounds of direct materials that we need to purchase. The direct materials budget translates the pounds of direct materials to be purchased into budgeted cost. So the next step would be to determine the cost. So if it's $20 per pound, we will then take the amount that we need to purchase. So 512 pounds we need for October multiplied by $20 is 10,240. Next, we can prepare our direct labor budget, which will show us the amount of labor cost. So again, it's going to be based on the number of units that will be produced and the labor requirements per unit. So the direct labor hours needed for each unit of finished product and the cost per direct labor hour. So here we're saying that we need 15 minutes of labor to produce 1 unit. Labor is paid at the rate of $12 per hour. So we will include the number of units to be produced from the production budget. For October, we are going to produce 710 units, and we'll compute the direct labor budget by multiplying the budgeted production level for each month by 25, so 1/4 of an hour, because they need 15 minutes to produce each unit. And that will give us the total direct labor hours needed, which we will then multiply by the rate per hour, which is $12. So for the factory overhead budget, we're looking at the budgeted cost for factory overhead needed to complete the total number of units that we're projecting. Their overhead budget is separating the variable and the fixed cost. The variable portion of factory overhead is using a predetermined overhead rate of $2.50 per unit of production, and the fixed overhead will stay constant at $1,500 per month. So now we can compute a product cost per unit using the 3 manufacturing budgets: direct materials, direct labor, and factory overhead. And then we can use this amount to help us prepare a cost of goods sold budget and a budgeted income statement. TSC is assuming it will normally produce 3,000 units, which will yield fixed cost of $1.50 per unit, which is computed as 4,500 of their fixed overhead divided by 3,000. The other product costs are all variable. We can produce a selling expense budget. So this one includes the sales commissions and the salary for the sales manager. The salary for the sales manager is a fixed cost per month, and the sales commission is based on sales, so 10% of sales, and then add those together. We can produce a general and administrative expense budget. So they have fixed cost of $54,000 per year, which comes to $4,500 per month. We're going to look at the cash budget next. So to prepare a cash budget, we will start with our beginning cash balance and add any cash receipts expected, subtract the cash payments. That will give us what's called a preliminary cash balance. And normally the company will have an agreement with the bank that they will keep a certain amount in the bank. So if the preliminary cash balance is adequate, then they will either repay any loan balance they owe to the bank, or if they don't owe anything, then that will just increase their cash balance. But if their preliminary cash balance is too low, then they will actually have to make a short-term loan with the bank. So first we need to know what are the cash receipts. So in this example, we are looking at this company has 40% of their sales made in cash, which means the remaining 60% are on credit. And they're expected to collect the amount that's in accounts receivable in the month following the sale. So we start off with our sales for each month. We are subtracting the ending accounts receivable because that will not be in cash. And then, so for October, we've got 60,000 in sales. 60% of that is accounts receivable, so that will not be collected in cash. It will be collected in the next month, so that will be collected in November. 40% of the 60,000 in sales is in cash, and we are also collecting the 60% from the previous month. So we're collecting in October, September's accounts receivable. So the total cash receipts for October come to $49,200. Now we need to look at the cash payments. So they make all of their purchases on account, so they owe for them accounts payable, and then they pay the full balance in the following month. So in October, they purchased $10,240. That's going to be paid in November. So what they're going to pay in October is what they had purchased in September, which is $7,060. So now we can prepare the cash budget. So again, we'll start with our beginning balance, add our expected receipts, subtract our expected payments to get our preliminary cash balance. And this company has an agreement with the bank that they will keep a balance on hand of $20,000. So we're going to look at this. We're starting off with our beginning cash balance. So in October, we started with $20,000. We're going to add our cash receipts from the cash receipts budget. Beginning balance plus cash receipts gives us our total cash available. So we have total cash available in October of $69,200. Now we have to look at the payments. So we just prepared the cash payments budget, and our total cash payments will include the income taxes and interest. The company currently owes a loan to the bank of $10,000, and they're paying interest at the rate of 1%. So 10,000 times 1% is $100. So now we can get the total payments. So the total payments is $43,565, and then we can compute the preliminary cash balance for October is the total cash available of $69,200 minus the cash payments of $43,565. So their preliminary balance is $25,635. Now remember, they have an agreement with the bank to maintain $20,000. So they owe $10,000 on the loan, but they have to keep $20,000, so they can only pay back part of the loan. $25,635 minus the $20,000 they need to keep on hand means they can pay back $56,35 on the loan. So their ending cash balance for October becomes the November beginning cash balance. And in November, we also owe 1% of the new balance of the loan. So initially we owed $10,000. We repaid $56,35. So now the new loan balance is $4,365. So in the next month, in November, 1% of that is $44. And then they're showing in November that they're going to make a large purchase of equipment of $25,000. So that will be part of the cash payments. And finally, we can look at the budgeted financial statements. And all of these numbers come from the various schedules and budgets that we've already looked at. So this is a budgeted income statement based on total sales, less cost of sales to get gross profit. And then you can see the different operating expenses. And then we have to take into account income taxes, which are 40%. And then that's our projected net income for the 3-month period. We can prepare the budgeted balance sheet. And again, all of these numbers come from one of the budgets that we've already prepared. And this is a good slide that you might want to print so that you can go back and look at the other slides to see where each of these numbers came from. But with your balance sheet, remember that the total assets must equal the total liabilities plus equity. And these are all going to be the ending balances. So at the end of the projected 3-month period, which is December. This concludes the video lecture for Chapter 20.